When you look at what's happening in the world today around the online classifieds, one thing that's pretty interesting is that everyone's getting closer to the transaction. So I thought for the next 20 minutes or so, I'd have a conversation about some of the things that I'm seeing as I wander around the world and as I work with various companies, okay, about getting close to transaction. And we're trying to put as much of this conference as possible around that theme. I think it's very poignant and very important for us to understand how much value can we as an industry extract from the ecosystem that we operate in. And to date, we've really just been chipping at the surface of the true value that's there. So we all know about what the ecosystem looks like. At one end, you've got the Googles and the vertical search guys, you've got clicks being generated. They go to portals, horizontal sites, that's general classified sites, agent sites themselves, okay? All about leads going to the agents who then eventually convert into sales for a vendor or landlord. So the buyer tends to come from somewhere. They might touch the agent directly, they might go to the agent websites, horizontals directly, or via the vertical search. Super simple model, we all understand that, okay? And that's all around the primary transaction. So when we talk about primary transaction, we're talking about the sale of a house. There are other guys involved in this transaction too, the secondary transaction guys. And they exist purely because the primary transaction exists. No one's going to take a mortgage if you don't buy a house. No one's going to buy insurance if you don't have a house, okay? And no one's going to get a relocation service if you're not moving. Traditionally, so many people have focused just on the advertising part. That's what portals are here for, right? That's where we all started. Go back the day when Rightmove launched and REA launched and ImmoWeb launched and so on. You're basically replacing newspapers. That's what you're doing. You're taking a traditional model and putting it online, okay? And the industry, of course, is up in arms saying you're here to replace us. We said, no, we're just here to replace the newspapers. But as this has all evolved, we're starting to find some challenges in established markets. And these challenges are happening for a number of reasons. Revenue growth is slowing with some of these guys, okay? And sometimes they're actually starting to hit limits of how much revenue they can have. This is interesting. I sort of pulled together some numbers of the year-on-year revenue growth for some listed companies. And just to make it sort of nice and even, the blue bar is 2015 versus 2016. The orangey color bar is 2016 versus 2017, okay? At one end, you've got Domain in Australia, and this is just, now for those who don't understand, Domain might come up a few times, they have both digital and print assets in the market. So they've been having good growth, but once again, it's gone from 26 to 18% growth. They're digital assets. The REA Group, Australian operations, because I'm just looking in the markets, have gone from a 17 to a 14% growth. Rightmove's from a 16 to 11. Zoopla, now that's the only one that's gone the other direction, but that's for other reasons. For those who don't know, it was basically a duopoly in the United Kingdom. Actually, it was highly fragmented originally. There was Rightmove, and then there was Prime Location and Property Finder. I remember we used to own it. And Finder Property and so on. And then Zoopla came along and basically consolidated the market and created a duopoly. The industry, fearing what was happening, said, wait a second, we don't like this. Brothers, let's lock arms. And they created On the Market. And then they instigated a rule. The rule said, if you're going to be with On the Market, you can only be on one other portal. So in the hope that that would somehow fragment the industry, of course, a lot of the guys went straight to the left to Rightmove, as you would, okay? And Zoopla got sort of hit in revenue. I think about a 25% drop, I think it was something around that, in number of agents who were using them, more or less, which clearly impacted their revenues. And of course then put pressure on Alex Chesterman and the team to think about what they do differently, and we'll look at that in a little bit. Of course, Rightmove then took off and just kept going, and On the Market has created a position for itself and is now even considering listing on the UK Stock Exchange. So that's why you see Zoopla going from a negative growth number up to a positive growth number. I don't have Selligere for the previous year, and ImmoScout 24. Even as part of the Scout group, you can look at the operations of ImmoScout 24. They've dropped from 9. So these growth rates are slowing for these companies. And what's interesting, and I looked here in Australia, if you start on the right-hand side, the total Australian real estate market, advertising market, is $1.2 billion. These are in Australian dollars. Then you go to the left. REA is already capturing 35% of that. Domain's capturing about 16% of that digitally. So combined, half the spend is going into those two digital assets. Throw in Domain's print assets, which is another 8%, and 59 or 60% is going to those two players. Okay? You can't keep growing at exorbitant rates because that 1.2 billion hasn't really changed for 20 years. But what they've done is a great job at migrating it from print to online and maintaining a lot of that value. And for those who are in the masterclass yesterday that we ran, you can see that the premier ads, or whatever the top ads are on REA now, cost you $7,000 for 30 days online. $7,000 for 30 days for one property. Right? One property, $7,000, 30 days. Phenomenal. So you can't keep growing. There's a challenge, right? If you're REA, you're thinking this is a bit of a problem when you've got market caps at $8.8 billion. The market's implying that you've got a lot of growth left. Fewer agents and developers are signing up, and they're becoming more reliant on depth products. And this is Rightmove. You can see here, this is their first half 2016 to first half 2017 growth. All of it's coming out of depth products because you can't go make more agents in the United Kingdom. Okay? 85% of their growth is just out of the depth products. So it's hard, right? You're starting to think, oh, geez, I've got to get more. At the end of the day, it's a price increase by another name, right? They're always advertising their properties. You just got to advertise in a different way. We'll call that a depth product, but it's still the same properties on the same website being looked at by the same people. Okay? Price increase, another way. It's getting harder and harder to push these price increases through. We did some rough calculations yesterday in the masterclass with one of the guys from England, and we worked out that at about 10% of an agent's commission stream is already going to Rightmove. Okay? Remember, in the United Kingdom, it comes out of the pocket of the agent. So around 10%, more or less, is going to Rightmove. They can't keep growing that at enormous rates. It just doesn't mathematically make sense. Revenues are potentially tied to fluctuations in the housing market. If you look at the way that the REA Group in Australia has structured itself, and Domain, when you're basically making most of your money out of premium products and it's tied to the number of listings in the market at any point in time, spring and autumn, when there are big selling periods, look good. Summer and winter, when the numbers, they decrease. What happens if the market tanks? Okay, there's going to be a problem, right? That's one of the challenges you have when you grow as big as this. Where do you drive growth? There's increased and smarter competition. Facebook guys are here. This is interesting. This is in the US. So if you go to Facebook in the US and you want to buy one of the ads online, you can actually target by behavior, and the behavior here is likely to move. That's a pretty cool thing to target a house to, isn't it? Okay? And that's because Facebook's partnered with Espelon. What they're doing is they're taking survey data and panel data and matching it against members of Facebook to work out by area whether you're likely to move. Can you as a portal do that? Target specific people who are visiting your site as being likely to move? No. You can't today, but Facebook can in the US. And if they're doing this in the US, it's just a matter of time. Google's into jobs now. We've all seen this. You guys all seen this? Google's jobs. You go to a search for jobs in the US, you get jobs in the search results. Now, what's interesting is the top ads continue to be, so we're looking on the left-hand side, continue to be AdWords. Business as usual. Then you got this big block of job ads. You know, there's 3 here. Click here to see more, and I've just blew it up there so you can see what that looks like. Okay? And then you get Indeed, who's the big guy. And Google's done a deal with Monster and Career Builder, but not with Indeed. Guess who the target is? Indeed. So this is going to happen. Will it happen in property? Probably. We all remember Google Base, that's right, and no one used it. So then, why would you give up? Because when you look at the market valuation of these businesses, they're in the billions and billions of dollars. There's so much value there. Okay? And this is what you get when you click on one of those ads and it goes to seeing the details page. It's no different to what you guys do. Okay? And they're doing it within the Google interface today in the US. And there's high financial market expectations. Look at this. Combined value of those 6 businesses is 22 billion euros. Market has very high expectations of these companies. They've got to continue to deliver growth in revenues and growth in EBITDA. If your revenue growth is slowing and you want to grow your EBITDA faster, you've got 2 choices. Cut costs or do something different, okay? And interestingly enough, I reckon even emerging markets are facing some challenges, okay? Because when people go into these emerging markets, they sort of have a bit of an expectation that's going to be like the Australias and the United Kingdoms and the Frances and the Germanys and so on, and the take-up rates. But you look something like iProperty, it's been around, what, 10 years, more or less? It's still about 30 million revenue operating across many dollars, revenue across many countries, and barely profitable, maybe 5–10%. You look at an REA or a Rightmove after 10 years, and they were much bigger and much more profitable. These are slower markets, okay? And the problem, and Michael, you probably see this every day, right? You've got to work really hard. You're dealing with agents and developers who are really slow to adopt online marketing. It's, you know, there's a lot of general classified sites that are dominant in these markets. The market structures are different. Okay? Monetization is, it's monetizing, but at sort of low levels. Low compared to when you see, you know, Rightmove is getting £1,000 a month out of an agent. You're not going to get £1,000 a month out of an agent in some of your markets, for sure. Yeah, no, per agent we're talking about. Okay? There's very high levels of competition in these markets because everyone's gone, oh wow, I want to be the next Rightmove. And they run in there, they get some funding, and away you go. Profitability is taking a long time to emerge, and there's impatient investors. Okay? Point is, initial growth projections sometimes get missed. Profitability may be a long way off, or the profitability we're expecting from these markets is a long way off. And there'll be pressure from shareholders in this process. So then you go, well, what do you do? Well, let's look at the available revenue pools in this whole process. So there's always been advertising on the right-hand side, okay? There's the tools, you know, think of CRM tools, virtual tours, all the things that are provided to the industry. There's the commission pool that you can go after, and then there's this secondary transaction pool. So you sort of overlay on that, well, and I took the Australian market as an example because you can get some good numbers here. There's $1.2 billion in advertising. 10 times that amount in commission is going to the real estate industry, developers, agents, project marketers, and such. And $2.2 billion just in mortgages. Okay? So you ask yourself, do I want to keep competing or fishing in the pool of 1.2 million, or do I want to start to fish somewhere else? And do I have the right to fish somewhere else? And the right to fish somewhere else is really driven by what's the asset I've already created. Brand in a market, visitors, maybe operational skills that I can leverage into these other pools. You know, the question is, what are the options to grow the businesses? Because if you're thinking here, I'm one of these guys, I'm sort of reaching a cap, do I extract more value from the existing advertisers? You know, they can only pay so much. But that's what REA and Rightmove and IS24 and all these guys are doing today. Very simple stuff. And have been for many years as well. You can expand internationally. REA Group does it. They bought the iProperty Group. They invested into Move in the US. They sold out of Dubai. You know, there's a whole bunch of stuff that goes in this. It's not hand to manage, it's actually hard to manage these businesses internationally because each market is different. What's happening in Southeast Asia is very different to what is happening in the Australian market. And you may overpay for the assets, and you saw those who have been following, the REA Group bought the iProperty Group at a $750 million valuation and had to write off about 20% of that in its most recent accounts. You can move into the agent tools market. You know, the Zoopla and the domains are doing that. But there's lower value. You're not going to get 50+% EBITDA margins out of it, but you will get revenue growth. And the agents won't pay you the same revenue stream either over time as advertising. So then you get to the more interesting ones, moving into the secondary transaction market and moving into the primary transaction market. Secondary transaction market, Idealista's doing it. The guys are here somewhere. You can ask them about mortgages that they're into. Zoopla's doing it. They're into Uswitch and money.co.uk. We've seen that. The REA Group's doing it with moving into mortgage broking. And then primary markets, Amin's doing it, and we'll hear from him around later on today around what the guys are doing there. I'll talk to you about what the REA Group may be doing in this market. Some stuff came out in the last week or so about it. So let's have a quick look. So in terms of mortgages, this is what's happened. This has all happened this year in a bit of a rush. I think they've all gone, oh, shit, growth. Yes, better do something different. And they've gone, well, let's go into two things. One is they acquired, so the REA Group acquired 80% of a mortgage broker, okay? Which basically means they get a lead, the mortgage broker finds the best bit of mortgage for you, closes out the deal, and you build a mortgage book, okay? So for those of you who don't understand, you'll see here that these guys do $6 billion of loans annually, and they've got a loan book of $25 billion. What will happen is the bank will pay you a fee for getting the deal done, and then pay you a percentage of the interest paid over the life of the loan. So you build a book, you get a revenue stream out of it, and you build a mortgage broking business. So they've acquired 80% of that for $67 million. In parallel, and I'm not quite sure why, I think it's more of a historical deal and they wanted to keep the NAB happy, NAB being the National Australia Bank. They've partnered to create a mortgage broking solution with mortgage brokers that the NAB is supplying out of one of its businesses, Choice it's called. And they say they're launching realestate.com.au home loans, probably forgetting that in 2005, there was a realestate.com.au home loans at that point in time. And we were a mortgage broker for 2 years before we sold out of the business. And we sold out of the business for a very simple reason. It's a very different business being a mortgage broker than it is running an advertising portal. Fundamentally different. And you need scale, and you need a dedicated team, and you need to do it very separately. Domain has partnered with a company called Lendy to create Domain Loan Finder. Same thing. They're participating in the secondary transaction. They're taking the commission in those deals. Why are they doing this? Because they've got access to all the eyeballs. You've got eyeballs, you know who's looking at property, you can start to predict when they're going to buy a property, you can bundle things up. You're getting access to people earlier in that transaction. Okay? Maybe REA is entering the primary transaction space. It was interesting that they recently launched a thing called Marketplace. And what it does is it connects real estate agents, project managers, and financial planners to properties, to developers' properties, right? Understand the concept? Go to developers. Developers say, I've got these properties for sale. It's like a clearinghouse. I'm willing to, we want to sell it for $300,000. We're paying 6% commission. It goes into this marketplace. REA's created the marketplace. It's reported they're partnering with Queensland Victorian real estate agents, some of them, to close out the transaction. Because remember, you need a license in Australia to close a transaction. And it's reported that REA is taking a fee on the sale of the property. Okay? And so they're getting some money for making sure the transaction can occur. The point is, eventually, portals with very high market share, very strong brand loyalty, capping out on where the revenue streams are going to go after the bigger pool. It's absolutely logical. Zoopla, this is an interesting one. I don't know how many of you followed Zoopla carefully, but clearly we talked about the story before. They were getting hammered because of on the market, the business that they had, which was all around basically listing of properties. They said, well, wait a second, we've got a problem, we've got on the market, we've got this one other portal rule, we'll challenge it in the courts, but they haven't been successful in that. They've got some customers coming back because clearly on the market struggled to deliver on the promise of replacing Zoopla. So they say, well, wait a second, let's grow the business. So they did a whole bunch of acquisitions, and it's really around a strategy. It says, I'll start, as you can see on the top left, with property, with Zoopla and Prime Location and a bunch of others that they acquired. I'll get into property, into the software business. So they acquired what's called PSG, which is Vibra. It's a big chunk of the market. 50% or so of all desktops in the United Kingdom are using that. And then they said, well, let's get into the data, which is really important. So they bought HomeTrack, which is a data business that provides AVMs, automated valuation models, to banks in the UK. So historically in the UK, if you had a house you wanted to get a mortgage against, you had to get a surveyor. It cost you £250. Took a week, and eventually someone gave a valuation and you agreed on the mortgage or not. Then what happened is Home Track came on. This is about 10 years ago, 15 years ago. And they said, wait a second, I can automate all this, and it's now £10 per valuation, which the banks will loan money against, now owned by Zoopla. And then they've added Uswitch, okay, which is a switching, utility switching comparison site. So when you're moving home, okay? And the reason I put over the top the money, because that only happened last week or the week before, they acquired money.co.uk, which was a comparison business for 60 different financial products, okay? So they've done this, and this is all their acquisitions, you can see, right? Here's what, 6, 7 acquisitions over the last 2.5 years. £450 million have gone into this to fundamentally change the strategy of the business, enhance the strategy of the business, a better way to think about it, leverage all the eyeballs they were getting in their Zoopla business and drive them into other businesses. It's probably a smart move. The outcome is that now 50% of their revenues are coming out of the property business, 34% from agency, 11% from other property guys, 5% from new home. And then the others are coming out of comparison sites. And this is before the money.co.uk acquisition, which should add another 30 million pounds. I think it's 26, 30 million pounds to what's already around 200 million pounds. So that's going to now make this property side around 40% and the other side around 60%, more or less. So they've said, look, we can't wait to be eaten by on the market. We can't wait. We want to get into these secondary transaction businesses. Now, then you hypothesize, well, wait a second. If property advertising becomes such a small part of your business, but you've still got all the fundamental assets, and let's say a Purple Bricks becomes a really dominant player, and you share the same colors in your logos, maybe you acquire them. And now you're leveraging Zoopla brand into transaction business as a possibility. And I'm not doing now, and I'm not putting my business at risk because the advertising revenue stream might be 25% of my revenues. But now I can play in the much bigger pool. I think that's probably the longer term strategy. They're closing the revenue gap with Rightmove back in 2013, sort of like 65 million to 100 whatever, and you can see the growth of Rightmove in orange and the growth of Zoopla in blue. So, but what it doesn't show you is the EBITDA margin, right? Because that would depress you. Because Rightmove's operating a 75% EBITDA margin. Zoopla is 30-something. I can't remember the number now. Because the problem with these new businesses is they have lower margins. And they squash EBITDA. Around 30, 35, 40%. But now I've got 200 and something million pounds to play with as revenue, which gives me a lot of oxygen to do things. Okay? Zillow Instant Offers. I don't know if you guys know this. Zillow launched Instant Offers earlier this year. What they basically said, prospective home sellers, can receive a cash offer from some large private investors, as well as a CMA, comparative market analysis, a proposal from an agent. Okay? You can then have 3 choices. Accept the offer, and you will get your money within a week. Clearly, they're going to lowball you because they're going to make money on the transaction. But you take the risk. Secondly, you can accept the offer and use an agent to close the transaction, or you can reject it and list it on the MLS with an agent. You get the choice of what you do. Okay? The objective is to make a more streamlined, friction-free transaction process and give the seller more certainty on what's going to happen. They're piloting it in Las Vegas and Orlando, and Zillow's saying they're collecting no money on this during the pilot, right? But if you're successful, you think you're going to keep doing this as a charitable donation to the industry? Of course not. You're either going to be making money by taking a commission of some sort in this process, or you're going to be taking a fee from the investors, or you're going to be one of the investors at the other end. You're going to play some role in this where you personally monetize, Zillow monetizes. Why? because they've got a beautiful amount of revenue and a beautiful amount of costs that happen to be about the same. We're talking about €1 billion in revenue, $1 billion in revenue, more or less, and $1 billion in costs. They're not making much money. They've got to do something different. Fantastic large audience, but they're not making the money. Also, agents are experiencing pressure. They're experiencing challenges in this too. Think about it. If you're an agent or a project marketer today, you've got the internet agents, the purple bricks, the easy property, the Redfins of the world, coming in and trying to change the way you do business. You've got traditional portals coming in and trying to sell. And we'll hear from Imran later on about what Zameen's doing. Okay? And then you've got sales-focused guys, just purely exist. You know, Square Yard, SoFun, Leisure, Prop Tiger, Sumo, so on, so on, so on. Who wants to be an agent? This is the ultimate innovate or die in this process. There's a lot of stuff happening. So what does closer to the transaction really mean for portals? Okay? You need to have super clear strategy. What are you doing? I think Zoopla's articulated a very clear strategy and is executing to that strategy. Good example. Okay? You need data and you have to understand your visitors, because your visitors are your lifeblood. Okay? They are the ones that are going to, you have to be able to leverage. I need to know, for example, what Javier is doing on the website, why he's there, so I know whether I'm going to target a mortgage to you, or might even give you a telephone call based on how you interact with the site. So you have to become these super big data vehicles that convert people from IP addresses into humans and know what they're doing. Of course, Facebook starts there. They already know who you are in detail. You need the skills to make this happen, because the skills you had to build whatever portal you've got today are not the skills you need for secondary and primary transactions. So how are you going to get those skills? You need to somehow make that happen. The business has to be prepared to take the leap into these new streams. It's not simple. One thing is to think in your head, yeah, well, we can leverage this into secondary transactions and primary transactions, we can do this. The other is to actually then do it. Okay? And we were chatting with some guys yesterday in the masterclass, and the conversation was a bit about, yeah, we know what we're going to do, but we've got to convince management, we've got to do this. It's like, if the business is not aligned and ready to take this leap, you're not going to pull it off. And you need a new set of measures, I think, to measure success. And I don't think ARPA is going to be enough anymore. You know, average revenue per advertiser, or whatever you want to call it. Okay? And we start looking at, and you know, we clearly do a lot of work with Mitula, because I'm chairman, right? And we look at the world through a yield per visit. How much money is being extracted per person who visits the website? What's interesting here is at one end, you have people like the REA Group, the Australian operations, and Domain, just about $1. These are all in Australian dollars. Just around $1 per visit. Okay? Every time someone visits that website, they're getting $1, right? Because they've converted in, because they've got a very good advertising, online advertising structure. Anyone who aspires to have the same revenue streams from the same products, forget it. Because one reason Australia has what's called a vendor-paid advertising culture, which means the agent's not paying for the advertising, the person selling the property pays for the advertising, whether they sell the house or not. Which means REA converts and Domain converts every single real estate agent in the country into a salesperson for their products. So it's a very different model, very hard to replicate. Got a couple other guys in here, Seek, who's in jobs. Interesting, the blue bars, Zoopla is getting 65 cents. Rightmove is getting 35 cents. Why is Zoopla getting so much more? Because it's getting all these additional products and services. And the more you cross-sell, the more you get people to buy a financial product, you get them to buy a switching product, you get them to do some, you know, the more they engage and buy, the better off you'll be. There's a few other guys which are in emerging markets. You can see the yields, and then we put in there just the Mitula Group, all operations, because we published that number at 4 cents a visit. Because when you got 75 million visits, if you could, I would love to be getting $1 per visit with 75 million visits each month. But that's not going to happen yet. But it forces you to look at the world through a different lens. And a quick story, I was with Gonzalo Del Pozo coming back from Australia after a trip maybe 2 years ago now, and we're sitting on a plane, 24 hours sitting next to each other. You end up getting a little crazy and started thinking things, and we realized that we were looking at the business the wrong way. The conversations are all around how many clicks, what's the yield per click, how many clicks you're generating, and so on. Then we realized that with that mentality, you end up thinking, how do I grow the number of visits? Because it's sort of a linear, well, not linear, but there's a mathematical relationship between them. Then we said, well, imagine we didn't have any more visits. How would you view the world? Suddenly you go, oh, you look at it very differently. So I challenge you all to look at your businesses very differently.